Welcome to my channel, and I hope you find this content beneficial. So today's video is a little bit different than the normal live trading recaps I go through, but it's exciting because Stinky's here making an appearance. Hi, buddy. Good boy. So what I want to go through today is how to figure out your first edge. I traded starting 2 years ago, and for the first over a year, I didn't have an edge. And I knew, I kept hearing different, professional traders and traders with success that found success saying you have to have an edge. Trading without an edge is a waste of money, and you're gonna fail. Because trading with an edge is, it's hard enough as it is. So I knew there was truth to that, and so I don't know, but I just kept trading without one, and I just sort of winged it, and was using real money, and it cost me some money. So although my first few months of trading was successful, um, it was dumb luck, and the market we were in a bullish market, and I was swing trading, and it just worked out. So then the more I learned, the more struggle I had. So um, yeah, then eventually I figured out a couple edges, and at least my first one, was a breakthrough, and I had like a couple months of uh net positive returns on the months, and then I would struggle because the market would change, and so the reason why, in my opinion, day trading takes so many years to figure out if you're gonna be you make it or not, is because there's so many different market conditions. So as soon as you start figuring out one condition, one type of market, then they change things up to keep you on your toes. So it takes years of just dealing with different conditions, all the different, most of the conditions to figure out, dial in what your edges are, and um, figure out what markets you can trade, what you can't, and then the ones that you can't, learning how to trade in those so that you can make money all year round, for the most part. So I'm not there yet. I can make money in, um, a few markets, but I still struggle with, a lot of the time. I mean, I'll have like 2 months of green P&L, and then I'll have 2 months or a month or two of red, or 3 months of red. I try to keep my losers smaller than my winners, but sometimes I struggle with that, and so it's just definitely works in progress. But I have put a lot of time and effort into trading over the last 2 years, and I'm one of those people that I do something 100,000%, and I've read a lot of books and just done a lot of studying, and just like I said, a lot of effort into it. I mean, I wake up, even a few months that I've done primarily paper traded. I wake up 4:40 in the morning, and just go prepare and stay up late preparing, and just reading and trying to learn. So I feel like I can hopefully provide some sort of value, um, to at least one person watching. So I pulled up, started a little bit on here on OneNote, and just trying to just establish what, um, to help you establish what your edge can be. So I'll go through and do mine, and you should be able to apply this to yourself. So, and I already have this done, but I'm just kind of doing one from scratch to help you out. So first we have, so I have edges here. I have setup one, and it's a Momo and trend continuation pattern. So to show you what that is, in my opinion, I have Tesla pulled up. Pull up Tesla on the 3 minute, and then we're gonna go through. We're gonna break down what for this setup, what it is and what I need to see. So I wrote down already. What criteria do I need to see to enter a trade? Relative volume. So that just to me means, like, in in DOS, I have this. Let's see, let's go over. So I have an RVol category here, and I don't even need to use this, but I can already see, um, just looking in pre-market or looking at the market open, how Tesla is doing per. It's easier for me to see on the 1 minute. So um, I know that this open for Tesla had um, okay volume. Is this right? Yeah. Tesla started off okay. Yeah, I do remember Tesla was kind of low. So the average, this is 10 period average, so the last 10 bars, the average. So it started off with decent, okay volume for Tesla, 155,000. And as you can see, there was no volume that came through here. So we put a horizontal. This is high day at that point, roughly. So where the volume came in for Tesla and it got above average was when we broke above the high of the day. So a lot of times, let's look at where Tesla was relative to the day before. So Tesla had a slight gap down, as you can see on the daily here. But we had this distance line here, right, that I was aware of, and by the time this really came into play, I didn't think it was going to have this sick of a move. About here, I thought, okay, this could be the breakout, for the day, but I was out of buying power by the time this came around, to take advantage of it. But um, so Tesla had a gap down, and then that gap down, right? So if we look at a 3 minute, let's look at a 5 minute. So Tesla yesterday kind of gapped up, sold off, and it closed higher than the prior day close. So if we look at um, so this yellow line is prior day's low, and so I don't know why this thinkorswim's kind of weird. It's showing this day's low, and then it's not showing this day's high. It's showing yesterday's high. So, anyways, we knew that high day was here at this level, and when when it broke over that, I mean there was a lot of volume into that and into that break. So let's examine that real quick. So um, it's right here, and these are 5 minute candles. So there's a lot of from 758 to 765. That's 7 points. That's a lot of money there. And it's getting decent relative volume. So one thing to know about relative volume is, let's say, like I can trade, and I think this is good for everybody to do. So here we have average or below average 13,000 shares over the last 10 bars. Excuse me. So when this is high relative volume versus these last few bars here. This is playable. So if you were stocking this setup right here, this is a horizontal level. This is one of my edges. So Tesla, is trading on lower volume through here. It's consolidating in this sort of a sending, or it's sort of wedge here. And sort of an ascending triangle too, but we have this pattern here, right? It doesn't even matter what it's called. It doesn't matter that. So what we have here is, let's mark some key levels. Bear with me here. So at this point, I'm going to show you a couple of my edges, and then we can get them down on paper. So So prior day's high. So now it's showing it on the 1 minute. Okay, so prior day's high. The day before's high was right here. So, um, playing levels like that. So I use pre-market high. So it was a gap down, and a lot of times the gaps, there's a fade move, which is to the reverse side. So we gap down. There's a lot of times there's a gap fill, which should have been to here. And so a lot of times I'll see what it does there. So, if I would have been paying attention, let's say daily 20 SMA. So we get a bounce off the daily 20 SMA, and that's a good indication that this might go higher as long as it holds there. So market opens, we get a sell off, and then we bounce. Right? It's not on the craziest volume. Um, this is pretty low volume for Tesla. I mean, it's not low, but it's nothing really crazy worth playing. I mean, right here there's off the open here flag pattern. It could definitely be playable. I wouldn't want to play this opening range break because we're prior day's low was right here, and the volume's not crazy, and it's a wide body bar. I mean this is a 744.50 to 747.50, so 3 point candle, and it's a green candle essentially. So this would have been red, kind of showed weakness, and then bears got trapped, and then we squeezed. I would play that, but we're holding above VWAP pop. So if anything, I'm thinking more potentially to the short side if we can get like a squeeze, and then we don't quite do the gap fill, and then we sell off. But we're under this. This right here is the EMA on the daily. See there, and this is prior day's close. So this is prior day's low. So we're under yesterday's candles. So any of the bears that are in here are essentially potentially going to get trapped and squeezed. So one setup I like here is this lag pattern is playable for a quick pop. So what that means to me is, and we're going to document all this after. So, hi Stinky. So I would, it's easy to see in hindsight, but this is what I do is I'll map levels like this. So this candle opened here and maybe got a squeeze, and so this is playable. The second so we have a pop, pullback, and then right here we have a candle over candle. This is the high of this candle. So this level right here is playable, in my opinion. And you can either, in my opinion, like I like to, my edges, sometimes I'll anticipate, sometimes I won't. It depends. Oops. So roughly this level. So as soon as that gets ready to, I think that's gonna break, I'll play that. A lot of times I'll play just this descending trend line, resistance line. But we kind of opened right there and probably just started surging up, and then the first target is right here. So here, 740.03 to 743.90. That's 3 points. 748. 748.38. So that's 38 cents. So that would be my first target, right? Basically, at least see what it does there. But if I'm sized up enough, like a couple contracts, then I could take some off just right there, like one off right there, and then into the strength. Just even that, like 1 point move, take some off, or take the rest off, whatever. Or if I don't take the rest off, say I see what it does there, it pops. I take some off into that strength. That's a 1 point move. Or 120 even maybe. Then or take some off, and then it fails, and I get out. Well, essentially, like a lot of it depends on sometimes I'll take some off. Second, this starts selling off. And see, this could be a fade move, and then we sell off. Um, it takes them off there. Otherwise, a lot of times it just depends on how wide this prior candle is. So the low of this is 746.50, let's say, and the high is 748. So $1.50, point and a half risk if you're gonna go to the low of this candle. That's kind of a lot because we're kind of already at high day. We've already made this move. You can go a lot higher, so I would just get out somewhere right here when this didn't work. So I'd sell one. This would essentially be a break-even trade. So then I have this level mapped here for the high day at this point. Okay, so we see what happens here. We sell off. So I'm break-even right here. We sell off, and we get a bounce a little bit above the low a day. So important levels, in my opinion, are the high a day, the low a day at this point, which I have marked in DOS Trader when I'm trading. I know the high of the day, low of the day, the prior day's levels, pre-market levels. So we have pre-market low as another level. So we have low a day, we have pre-market low, we have the 20 SMA here. So these are some levels that you can lean on. So another setup, right? And we're going to document all this, like I said, is if we were to sell off down to here and we were to a little bit lower, because this is essentially 745.50 to it's at 1 point risk right here, and you'd have to be quick probably to grab a dip into here. So my chances are my thinking would have been like, okay, it's not quite dipped enough. I needed to get maybe 30, 20 to 10 cents or 1 cent to 50 cents from the low day here, and see, okay, it starts to get a snap back, and then we start trending higher. So an entry could be we sell off here, it gets wicked up, and this is a hammer candle, hammer doji, and right here at the high of this candle, hammer candle, that's an entry. So we pop down here, we squeeze up, enter there with it depends how you want to do it. There's multiple ways. So sometimes I like to do it with the stop at the low of this candle. So I'm taking 745.50. So $1.30 risk right there. 746.90. And then 745.50. So $1.40 risk. So that's kind of a lot of risk. I might, in this situation, I would keep the low of this candle. So I get in right here. So my risk is 60 cents basically. So we're risking 60 cents, and then we have the 200 SMA right here is a red line, and then we get it. We squeeze above the 8, which is this tan line, peach line. So another level to play off of is, this is an ABCD. So yeah, this isn't an ABCD, but let's say we had this dip here, and then we dipped a little bit higher here, like we held right here, and then went. So that would have been playable. Risking off this low here, and then playing to this high right here. And then the trigger could be here, which is this sort of a W pattern. Just here's the first part of the W, and this is the middle upper part, and then lower right, and then play the break of this level. So it breaks here. Okay, it closes right here. We're in right here. Closes a little bit lower, and then we don't break below this candle. So the risk here, 747.50. See, the low of this one is 746.40. $1.10 risk. So Tesla, that's not horrible. We are right under the prior day's low, but that that doesn't always. I don't always play off that level. Like, I just kind of to show where we're at, and a lot of times I don't play off that, but I just it's to gauge where we're at. But this is an area where bears will get squeezed. Right under the prior day's low, we squeeze them out here, and then we start going lower. Okay, they're like, okay, maybe they just squeeze out the shorts that were in here. So we see we got this wick here. This wick can't break. Can't break. Okay, we start to fade down. So let me play. A lot of times bears will get in right here, break the 8 and the low of this candle. Or even they'll get in right here. It never got triggered. Because this candle couldn't hold. They don't get in there, so they get in. Let's say here, and then start getting moved down, and then it doesn't break down, and then bulls get in here at the break of this W, and sensing, squeezing above VWAP here. So, this has a lot of like different criteria. We have this technical level here. We have technical levels below, like I said, pre-market low. We have the 20 SMA on the daily, and we have low a day. We're right under prior day's low, which is the level, like I said, where bears get squeezed. We have the all that criteria. That just adds to this trade. So this W break, play that. We have this hammer right here. This is all adding to it. So it comes down to how picky do you want to be. In my opinion, I have certain basic criteria that I'm going to write down in a minute here, like the high volume, high options contract volume, or decent volume, relative volume at least. And then I need some sort of a setup. Like I need a level to break, like this high day, or I need a pattern leading up to this high day, like this W pattern, and with good risk to reward, or reward to risk. So that's what we've been going over. So depends on how aggressive I want to be. Sometimes I will take an entry like this right here. It's right below VWAP, anticipating that break, seeing this W potential, and this is bullish sign right here. We break that, and then we break this W. It depends on how early and how quick I am. So say I'm in here. Like I said, the risk here, it would be the low of this candle. That's 60-cent risk. And then so initial target, like I don't get specific, but I definitely would take profits into high day here. So we get even just getting this close. So let's say the high of this candle, 748.83 is 748.75. So 748.75, and I'm in at 748.75, and then in at 747. It would be a late entry, or 747.50. So it's $1.25 profit right there. For 60-cent risk. That's good. It's like 3 to 1. So we hold above the high day, and then we squeeze up. We don't gap fill. We sell off here, right? So a lot of times, this is where I get in a jam. So at this point, high day is here. Okay. So we squeeze up. Let's say I didn't catch this, right? So that's already one trade there, and then where I would stop out would be likely so I take profits into the high day there. On one, let's say I was in 2 contracts, we take profits into high day there, and then I would, this is a problem I have at the worst case. I would, in this situation, I would take profits like into this spike, which is, there's no reason to get out yet. So, in an ideal situation, I would, or in another, more ideal situation, I would take profits right here at the break of this candle under candle here. This candle we have up, and then this candle breaks below the low of this one, and get out right there just to lock in profits. This is an approach I would take, either profits into the strength, final profits into the strength here, or here ideally. Like on a Friday for sure would be the most risky I'd want to take it probably, but on another day I might give it till the low of this candle. So because it broke candle under candle. So that being said, let's go on with another setup. So we didn't quite gap fill. We sold off. Now, where I'm getting mistakes are like if I buy it, we've had this move that was um, off this little pivot low here to the pivot high here was 664, $6.64, and it was a point, almost 1% move. So, excuse me. So that's a decent little move. We're not too extended off the 8 um, EMA, which is that um, reddish peach color line. But a lot of times I will buy, right at the 8 EMA here, which is a little bit, we just had a over 6.5 point move. And a lot of times we broke over the high day, we will get a drop down to high day or a little bit above or a little below or VWAP here. So I've made the mistake plenty of times of getting in at this 8 EMA when it's a bit it's came 6.5 point move. So, um, like if you run a Fibonacci from this pivot low, this pivot high, that is not where you want to be getting in at all if you're going off Fibonacci. This never triggered for a Fibonacci like a 50 or even like right here would be good, but um, so that's a mistake I've made, and I'm really trying to not do that anymore. So instead, what I'd like to do is see what happens. Okay, we sell off, so I'll wait for a trigger. Don't be aggressive. Don't catch a falling knife. 'Cause that's a falling knife. If I get in here at 750.80, and it sells off to um 750, that's 80 cents. I'm already sweating 80 cents. It's contracts, especially like on a Thursday or Friday. I'm sweating. I'm down 80 cents from position, and I'm like, okay, crap. Is it gonna go to VWAP? Is it gonna go 748? $2.63 lower, or is it gonna hold there? Is it gonna go low? Like, are we testing low a day? Like, what's gonna happen? So let's say I was in that. This isn't an edge right here at all, in my opinion. Unless this is a proven trend, like let's say right here, we're holding the 8 now, so I could play the 8 here in an uptrend. That's an edge. It's just trend continuation, in my opinion. So, but buying this until it's proven that it's holding the 8 is a bit risky, and it usually doesn't work out in my experience. So we get dip below the 8. We kind of were holding right here, and this level, um, if you're quick to notice, this level holds roughly. So seeing, yeah, this breaks below it by a few cents, but so if I'm paying attention, I see this basically a W, almost an ABCD, because if this was lower and then this was higher, this would be an ABC that I would take with entry either here or anticipating that. Even like right here, like we have pop, pullback, and then to anticipate that, I would a more aggressive entry would be the high of this candle right here, with the stop right below here. This is great setup. Even this setup right here is great. So we have a high of 750.40 and a low of 750. So 40 cents of risk. That's for um a first target of $1.20. So 3-to-1 risk reward setup right here. A plus setup, in my opinion, because we're above VWAP. We're above the 34 EMA, which I love to use for trend direction. And we're this is potentially like any longs that got out. So anybody that bought the 8 EMA here or bought the highs here is getting stopped out here. Some of the people. So then some bulls come in here, shorts cover, and then it doesn't hold, but it gets bid up, and this level holds. There's a buyer here at 750, which is a key level. It's a psychological level. It's holding above the day's high or above prior day's low. We're approaching the 8 a.m. on the daily and yesterday's close. And we're approaching pre-market high. We're above the 200, things, like I said, VWAP. This is bullish. So there's 40 cents of risk to make it a $1.20 first target. The high here is 51.20, so $1.20 for the first target. So this. So here's the risk. Here's the risk for this reward. That's three to one. And that's a first target. Now the second target would be the high a day, which is right here. So um so so we're risking from 750 is our stop out, right? Like a close below 750, like we start. I mean, it's going to be more than that risk because let's say this candle, we go here and then we close right here and then this goes down. I'm either going to stop out right there at 750 or see what it does at 34, which is because it's so close. So 70 cents risk. That's another 30 more cents. So potentially 50 to 70% risk. Depends on my mood and my feelings at the time. But here's another one. Let's color this one a little bit different of a green to show that there's two different risk levels here. So this high right here, $2.13 higher than the 750. So 120 or so it's $1.20 profit and then $2.13. So another point. Because 51.20 to it's $1, almost another dollar point return. So that's insane risk reward. So that I would ideally or probably be out of my entire position because I enter. Let's say if I caught this right here, 40 cents risk. If you want to be aggressive, 40 cents risk. Like if this breaks down, so you see this kind of sell off here, squeezes up, we take enter. No later than 1 cent higher than the 750.41. So higher this candle. We enter there. This gives 41 cents. And then we take one contract out at $1.20 move. Or that's $1.20 of so no dollar 750.41. So that's 80 79 cents, 80 cents, something like that. Roughly. Now what I like to do is like I said, see what it does right there. If it squeezes right above that level, and the shorts that got in right here, and potentially these shorts are going to get squeezed. So what I do is wait till usually if it gets to, unless it's a Thursday later on or a Friday, and I'm playing weeklies, I'm just going to get out half right there and half at this target. No questions asked. But other than that, or if I'm have decent profits on a Thursday or Friday, then I'll give it a second. But so see what it does there, and if it doesn't just keep squeezing, then I'm out. But let's say for argument's sake, we're gonna get out half there, so that's 80 cents profit there, and then this is so 52.14 to 175. So right here is 175 profit. So if you were to take 3 contracts, you can take risks right here. So it's basically $1.20 risk. So you have 3 contracts. So that's 40 times 3, $1.20 to make. I think it's $1.20 risk to make. So 240. So you're up $2.40 right here. Roughly. So take off, like, let's say you're in 3 contracts right here. Okay, take off 1, take off 2, and then let 1 ride. And where my exit with that one would be right here, because it's popped. And then unless it was a Friday, Thursday, Friday, I would scale out. This isn't an ideal situation, so I'm in right here, scale out right here, and then this pops and it closes right here, and then this one right here. I mean, I'm not gonna let this one go. Probably gonna be out a little bit higher than this candle right here. Or it could, if you were, so that's what I tend to do, right? Let's say I'm in 3 contracts on something, that happens. But the right answer is you've already made good money on the 2 contracts, right? Scaling out, and this one closes here, but see what it does at the 8. It holds the 8. We have this doji here. It's a higher low here. We have a lower high here, but it doesn't. We can use this low as low here, and this pivot is the stop. Use that pivot as a stop, and you let that candle run, and then take profits right here. Or if you're really ballsy, you can let it run. And then once it gets up into here, you set a trailing stop of like $100, because you're already up on this contract. Let's say it's a 40 delta. You're in. Yeah, basically, long story short, I think you get the point. Is if you're really patient, there's room to run on that last contract. You have. You can set a stop at break even. So you get it's not gonna be a break even here. Gonna go, and then you can set a stop at break even, and then wait for, like, okay, we have, looks like a head and shoulders here, but it's not. It gets squeezed up. Okay, so then now this looks like a head. This looks like a shoulder. Looks like a shoulder. So this level right here is my stop. So with that being said, that's 762.11, right? This is an ideal situation. I'm not at the level right now where I'm performing this perfectly. I mean, the level I'm at, the best I'm doing right now is I buy 3 contracts of like something like Snap or Facebook or something, and then I scale out 1, 2, and then 3 right there. And then I watch it run the rest of the day. So I'm trying to dial in my edge and teach you how to establish your first edge. So, with that being said, so we can see how this would work out. So let's go to. So we have criteria. So we have high relative volume. Volume on contracts have the W. It could, let's say, instead of this being a W, this is a full pennant, or holding above, which almost say this is not a bull pennant. Kinda here, here. Someone consider that. Breaks down, squeeze. Can't really do whatever you want. It's a bullpen kind of so that holds, squeezes, holds. A lot of times they'll break above and then they'll hold right here. So we need a pattern, W pattern, a pennant, flag, key, level, or levels. So like I said, that was pre-market level above, that was high day above, or like in this situation, we had a VWAP, we had levels here, we had 20 SMA, pre-market low, low a day, levels around. To, one, to judge the setup, and two, to play off of. If we're consolidating right below pre-market high a day, and then we're near the 8 MA on the daily, and the Friday's close, and then this level right here is a volume weighted average price from a high volume day. This is a volume weighted average price from a high volume day. We have prior day's high right here. Like I can see the potential here. So I need the key levels. W, pennant, flag, rectangle, basically. Basically a consolidation. Levels, and then let's see what else here we have, and then ideally, so a lot of times I will trade just off of this stuff, this right here. Okay, but to make the edge more advanced, the more the better. We have and need good risk reward. We need at least 2 to 1 at least 2 to 1, preferably Jesus Christ, preferably 3 to 1 plus. Okay, and then ideally we would have breaking news and or major news. So this criteria here, is very good. This is enough right here, in my opinion, for a good edge. These sort of patterns, but you can get even more specific, like a stock that it has to trap below prior day's high. So you can, if you want to, it depends on how aggressive you want to be, how many setups you want to trade, how much buying power you have, and all that. So excuse me 1 second. So if you want to get even more picky, rude, and conservative, right? You can have um, must trap shorts below key and now you can have 20 things, right? For an edge, and then have a rule that um I need at least. So let's take it a step further. So we can have mandatory criteria and um optional upgrades. So we can say 2 to 1. Level and levels, and this alone can be your edge. If this is your trading style, you can go a step further. And on here, let's say you only are comfortable trading a handful of stocks. Under a stock must uh, or that this would be something that I would be interested in possibly. But also, but I'm open to more stocks. I'm just trying to give you options here. Um, and also another one. You can also do a lot of people find success, and I've done this at times. Is if there's major breaking news on or a stock in play like AMC, you can trade the sympathy play. Like lately, AMC's been more in play, but you could trade GME or BlackBerry or another small cap that's a meme name. Um, yeah. So this is one edge, right? So we've established an edge, and this is a lot of most of this is one of my edges. And so I'm really hungry right now. I'm kind of like low blood sugar, so I'm gonna end this video. But the next video I do is gonna be developing another edge. That's gonna be a counter trend edge. And so I'll go over the criteria for that I use, and I'm sure there's something I'm missing here right now. Like I just got to get some food in me, and I slept all the way till 6 p.m. today. It's Saturday, and yeah. So just you get the point here, hopefully, and because when the first year of trading, I didn't even know how to develop an edge. I didn't know, and if you're having trouble, like I had trouble figuring out what patterns were and what was relative volume and all that, but hopefully if I explain that, and you can look up patterns like W's, pennants, flags, rectangles, you know, ascending triangles. Yeah, so you get the point here. You can apply you can switch out what you like, and um, but ideally there's 2 to 1 reward to risk. Um, so on an A plus setup, in my opinion, for my edge, has to be an A plus setup. Um, and if I deviate from that, I've broken my rules. So these are the rules, and if I know that when I have all these, when I have major news, when I have at least 2 to 1 risk score, when I have key levels, and all that, I have a high probability of winning a trade. And then therefore, the more experience I get, like I'm getting more comfortable with sizing up 2 and 3 contracts or more on setups where I have this criteria. So, and then also another thing I forgot to put on my edge here, daily. Uh, so I have to have a setup on the daily, hourly, or 15. Like this Tesla here, what we're talking about is we had a setup here. At first we didn't, but we bounced off the 20 SMA, so that's a daily setup. So yeah, we did. And then we have this pivot low here, and then a higher low here, and then this is setting up for a squeeze, which it did. And there's daily break here. There's another setup here, which was at this around this prior day's high level, and then were to break it down, like we had prior day's high, and then we had you can do something like this, something like this inverse head and shoulders right here. I remember noticing this on Tesla. Head, left shoulder, right shoulder, and it didn't break. It broke here, squeeze. Um, yeah, and then we just kept breaking these levels, squeezing higher. So yeah, there's this was definitely holding up. So there's this is a bearish pattern a lot of times, but this thing squeezed up, squeezed, popped, kept going. So I'm gonna do a series of videos. I'm gonna do one or two more videos tomorrow on different edges, because you can just break down an edge as simple as um I see a pop in the chart, pop higher high, higher high, higher high. Okay, pull back, and then pull back, and then candle over candle. Seconds breaks up. I'm out with a stop below the prior low's candle. You can have it as simple as that, and stocks under $100, for example. Let's say you're new, and doing one share, and then you're out at the break of the low of that candle, and your target is the high, like I explained in the pop pullback candle setup, candle over candle setup. And you can apply the same thing to the candle to the candle, candle under candle to the downside. But anyways, thank you for watching. I appreciate it. I hope you have a wonderful day. I really hope this video has helped. And yeah, thank you. Goodbye. Goodbye, and happy trading.